I believe that the market is sleeping on these three undervalued stocks, but I'm not. I believe they have multi-bagger potential, and history tells me that patient investors get rewarded. If you want to see what I'm investing in February, let's dive in. Stock number one is a recent purchase of mine that I just started, Adobe. Now, here's one reason I like Adobe so much. I hear people are sleeping on Adobe. Paul, Adobe's going to get completely eliminated by AI. Literally, I've heard that Adobe's going to go to zero because of AI. Maybe. That's possible. You know what else is possible? It's possible that I wake up tomorrow and I find out that I'm the long-lost son of Warren Buffett and I'm going to inherit billions of dollars. It's possible. Is it probable? That's what investing is about. I look at Adobe and I see a company that generates immense cash flow. $7.9 billion last year, $6.9 a year for the last 5 years, which is much higher than their net income. So they're reporting greater cash flow than their net income. Okay. Profit margin. Well, first off, gross margin of 89%. Guys, that means every extra dollar they bring in, almost 90 cents of it goes to the bottom line to pay overhead and taxes. That's a lot of money to sit there and go to zero. It's one thing if they're making like 7 or 8%. I'm like, listen, there's low margin business. They could go under, etc. But then they also make 30% profit margin on that money. Guys, huge, great balance sheet, only $8 billion of debt. Look at this ROIC. Moat status, 30% last year, 22% over the last 5 years. Again, is it possible to go to zero? It is, but it's very hard with these metrics for that to happen. Let's go see the 8 pillars and see what they say. Guys, we got 6 checks and 2 X's. And the 2 X's, the 5-year PE, 5-year price of free cash flow. Now remember, just because there are X's here doesn't mean the stock is overvalued. If you knew for sure that Adobe was going to grow 30% a year for the next 20 years, you'd probably be willing to pay double or triple this number right here, maybe more. Actually, definitely more. So overvalued is relative to what their future holds. But remember, the future is unknown and we don't know what's going to happen then. So therefore, we don't know if this is overvalued or not. Now, as I said before, low debt, buying back shares, which is, if they're undervalued, this buyback of shares is a great idea. And I want them to increase that. But here's what I love. $10.3 billion increase in revenue led to $3.85 billion in free cash flow. That's a greater margin than their overall profit margin. They added 35 to 36% of their revenue went to free cash flow growth in the last 5 years. That's huge. And guys, the financial flex isn't just there. They also are flexing the creative muscle. They hit impressive milestones that absolutely highlight their leadership in the tech industry. They reached an amazing annual revenue of over $21.5 billion, which is a 10.8% increase from the previous year of 2023. And to no surprise, its digital media segment, home to popular tools like Photoshop and Illustrator, led the charge, raking in $15.86 billion of that, which was 11.6% year-over-year growth for such a mature product. That's what's incredible. Now, a big contributor to the success, Creative Cloud subscriptions, which saw remarkable expansion, further cementing Adobe's subscription-based model. Before, you bought the CD, you put it in there. Whenever you needed an upgrade, you went every 4 or 5 years and bought it. Now, subscription-based. The company's integration of generative AI into products like Photoshop and Premiere Pro is absolutely revolutionizing workflow, giving users smarter, faster tools for content creation. This is why I don't believe that AI is going to hurt Adobe. I think AI will actually help Adobe. And to support its growth even further, they've also expanded their global workforce to nearly 30,000 employees, reinforcing its commitment to innovation and talent. These achievements show that they're not just keeping pace with everybody, they're setting the standard for everybody. So let's go see what analysts think about this company's future. Let's go to the analyst estimates. $21 a share in profit this year, growing to $35 in the next 4 years. That's impressive growth, guys. Look at that. Double-digit growth in earnings per share every year. Let's look at revenue growth. Same thing. $24.26 billion to $37.7. 11%, 11%, 13%, 11%, 11%. That's a lot of growth. And again, they're analysts. They have their bias. But what we have here is a story that has great numbers and a great story. We got to put them together now. Because a story by itself is just a fairy tale. Numbers by themselves are just an Excel sheet. And that's why we use the stock analyzer tool. This tool is what we use to integrate the story and the numbers together. If the story is remarkable, you put in better numbers. If the story sucks, you put in worse numbers. It's that simple. And that's why this tool is used over 1 million times per year by people who use our community. And it's the most shared screenshot in our community. And I even see it on Twitter. So let's go see what I did in the past for Adobe. Now, guys, I do a 10-year analysis. Look how conservative I was here. Analysts are sitting there calling for double-digit growth. I put in 6, 8, and 10% revenue growth. Profit margin, 26, 29, 32, and free cash flow margin of 38, 40, and 42. That's that 38% there in the last 5 years. So I'm sitting here saying, hey, this gross margin is very big. They spent a lot of money adding more employees. This could be the 40% number here soon. PE, price of free cash flow. Guys, the market average is 15. What's right for you? I don't know. I put 18, 21, and 24. But again, if somebody told me 20, 23, and 26, I'd probably buy into that. If somebody told me 15, I'd be like, really? High return on capital? That shows that they're a better company than and it's growing too. Look at this return on capital, it's growth. It shows that they're establishing their leader and moat status there. Now remember, I doubt they have a lot of reinvestment opportunities in this return on capital, but this is showing how they keep establishing themselves and keeping themselves as a leading company. They don't need a lot of capital to do that, which is wonderful. And my desired return, 9%. Guys, I say it 1,000 times. That's just for me to find my intrinsic value. You need to put a higher number in there for your margin of safety. What's that number? Depends how comfortable you feel. That's going to be different for everybody. That's why I started putting in 9% here. I hit the analyze button. The stock's currently at 431. I'm going to focus on the discounted cash flow here. Low price of 400, high price of 730, middle price of 539, which means based on a discounted cash flow model, if you pay today's price of 430, you're looking at about a 12% return if all my assumptions come true. That's pretty impressive. Stock number 2, Southwest Airlines, another position I hold. And guys, for all these positions, I hold them. Don't buy it just because I or anybody else. Even if my logic makes sense to you, you still need to make sure you fully understand why you're buying positions. So my play on Southwest is one thing and one thing only. Let's go look at these numbers down here. The stock is down significantly. This is what my thing is based on. 5-year profit margin of negative 0.37, 1 year of negative 0.18. Before COVID, they were doing 10 to 15% profit margin. I'm hoping, my belief is there's going to be a reversion back to this number. And that's where my entire play comes in. Because you know why? You look at their revenue. They have record revenue, $25.44 billion. Highest revenue they've had in history. At 10 or 15%, call it 12%. What is that here? That's $3 billion in profit. Great run airline, 20 PE, $60 billion market cap. They're currently at 18 billion. That's my thesis. Because guess what? Let's look at the pillars. They suck. Look at these pillars. Just absolute garbage. And this is my point. You don't buy or sell based on the pillars. The pillars tell a story. This story tells me this company's been beat up based on their history. And I'm willing to make a bet long-term on Southwest that they're going to go back to being the number 1 run airline in the world. They were profitable every single year from going public until COVID. Now, in Q3 2024, the airline hit a record $6.9 billion in operating revenue, up 5.3% from the previous year, which is great news for investors. But that's just the start of this transformation plan. By 2025, Southwest will break from its no assigned seating tradition, rolling out assigned and premium seating options. They're also diving into vacation packages with Getaways by Southwest, combining flexibility with convenience. Now, on the international front, they're partnering with Iceland Air to boost connectivity, starting with flights from Baltimore, Washington in 2025. And after pressure from Elliott management, the board is getting a major overhaul. 6 directors, including Gary Kelly, are stepping down, signaling a governance reset aimed at improving performance. With bold moves in customer experience, global expansion, and leadership, Southwest seems determined to chart a profitable new course. I truly believe this company will get back to the days of profitability. Now, let's see what analysts are saying here. Do analysts agree with me on their profitability? Well, not necessarily. They're expected to do $1.61 this year, growing to $3.30 in the next few years. So maybe they don't think that profit's going to get back to that 12, 13% level. But look at this revenue growth. 5%, 5%, 10%, 5%. That's a lot, guys, for an airline especially. But airlines becoming even more popular. Airline travel is becoming all the more popular, but it's important. On such a capital-intensive business, you gotta be willing to buy the best. Don't buy the crappy ones. That's why I'm focused on Southwest. I hope they have not become one of the crappy ones, but we'll check it out. So let's go see our stock analyzer tool so I can show you guys my assumptions on Southwest. Now guys, this stock analyzer tool and our software are so incredibly popular. Like I said, thousands of members in the community using the stock analyzer tool. And the stock analyzer tool started as an Excel sheet many years ago when we were making this channel and people would say, how do I get the software? So we made it. But if you've gone to sign up to everythingmoney.com/sign up, you'll notice that there's a wait list now. Our current software includes everything here: stocks, real estate, retirement, economic data, everything. But behind the scenes, we have full-time developers working constantly to make changes. I built the software for me, but now it's about helping you make better investments. It has to be more about you. But I use this software every single day to buy real estate and stocks. Today, I'm closing on another vacation rental, multi-million-dollar vacation rental that was all analyzed through the real estate calculator. As the software grows, we're going to continue to focus more on you. We've already launched a lot of the changes we've decided to make. So if you join today, what we're going to offer you is you get grandfathered in for life on everything before we split it all up and offer it individually. This is the best deal that we're ever going to offer. So as long as you join the Everything Money community before we make those changes, you can keep your pricing tier as well as the software after we launch the changes. So click on the link in the description below, get access to everything we have to offer, including our investing tools and community, and I assure you, it'll be the best investing decision you'll make this year. Guys, I did 2%, 4%, and 6% revenue growth. Look at my profit margin and free cash flow. I didn't even go as high. I went 8 in the middle, 5, 8, and 11. And for my PE and price of free cash flow, I didn't even give them a huge premium, 15, 17 and a half, and 20. And my 9% returns, guys, analyze button, the stock's currently at 30. This is why I like it. 32 on the low side, 115 on the high side, 66 in the middle. Based on today's price, that's a 21% discounted cash flow return. That's pretty impressive. To me, the juice is worth the squeeze here. Am I right? I don't know. But if I had 30 stocks with this kind of potential returns based on lower than historical numbers, I'm going to be a pretty wealthy person, in my opinion. Doesn't mean this is going to work out necessarily. But again, you've got to feel comfortable with it. You've got to do your own research, and that's why the community is so great also, because there are people in there who will be able to talk to you about Southwest Airlines. Stock number 3, Nike. Guys, Nike is incredible. And look at this. Back here when Nike hit $180 a share, people were telling us, I said, I'm not interested in Nike under 100. People said, no chance it goes under 100. I love it when I hear people say no chance. That's basically my way of knowing that it's going to go below a certain price. It's currently at $74 a share. 52-week low was $70. So not only did it go below 100, it went 30% below 100. Guys, amazing company. $49 billion revenue coming in. Free cash flow of $5.5 billion last year, 4.75 in the last 5 years. I've literally had people tell me the company is dead. They have more cash flow in the last year than they had in the last 5 years. Growing return on capital. Man, what a dead company. Guys, they have LeBron. They have MJ. Both their sales and their shoes are increasing. They got rid of golf to focus on what they do best. Let's go see their 8 pillars. Let's see what it looks like over here. Guys, 1x. And that's the price of free cash flow. The rest of these are all check marks. Now, the reason being is the price of free cash flow is a little bit lower than their 5-year net income. So that's why you have this one a little bit worse. But guys, this is almost an 8-pillar thriller. And guess what? This company is moat status. If I asked 100 people out there, what's the number 1 sports apparel business? How many are going to say Nike? Guys, Nike is resilience, innovation, and dominance in the sportswear. By 2025, it's clear that the company is firing on all its cylinders. Under new CEO Elliott Hill, Nike is returning to its roots, prioritizing athletes, product innovation, and strengthening partnerships. Hill's leadership inspires confidence in the brand's future trajectory, which was under fire lately because of the stock price. Because remember, news follows the stock price. In our principle-driven investing approach, it is very important that we remember those tenets there and don't look at market price to determine whether you're right or wrong in the short run. Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. In the recent voting machine of Nike, what's happened? The stock has been not very popular. But since this time, revenue and profit are up. So the fundamentals will show in the long run. Now, for those people who care, Nike has an immense commitment to sustainability, targeting a 70% reduction in emissions by 2025 and investing $125 million to address racial inequality. Now, I know a lot of people, that's controversial, and a lot of people have been against this lately, but these resonate with today's socially conscious consumers and enhance that brand loyalty. Financially, they're a juggernaut, posting $12.4 billion in Q2 revenue and extending its 23-year streak of increasing dividends for those who love the dividend. And that dividend, about 2% for the future looking forward, but it eats up a big chunk of their cash flow. Not quite half, but a big chunk of their cash flow. Innovative collaborations like Caitlin Clark's signature shoe position Nike as a leader in growing markets with a $33 billion brand value and unmatched global presence. Nike continues to set the benchmark for performance and sustainability and, from my opinion, long-term investor confidence. What world would we have to live in for Adobe, Nike, and Southwest to all be gone in 10, 20, 30 years? That's the question I'm asking. Yes, if you pick 30 or 40 companies, few of them are bound to be gone from acquisitions, mergers, etc. But what are the chances that what I'm hearing lately is Nike is dead, it's done, go woke, go broke? I don't agree with that. But let's go see what analysts think. And again, analysts have their bias. $281 per share in profit this year, growing to $636 in the next 4 years, well into double-digit growth. Revenue growth, not as much. 4, 6, 18, 6% with the decline this year according to analysts. All right, so we go back to our favorite tool that merges the story and the numbers together. And that's exactly it, guys. If you're a person that thinks Nike is dead, then put that in here, because still, a dying company is still worth something. If I told you could buy Nike, the entire company, for $1, you would take it, because you can get $5 billion in cash flow next year. You'll get $5.5 billion return on your investment. That's incredible. $5.5 billion extra money. So my comment is $1, $10 trillion. They're both not going to happen. Somewhere in the middle, it makes sense. So what did I do? 3, 5, and 7% revenue growth, profit margin and free cash flow of 10, 11, and 12%, PE 20, 23, and 26, and my 9% desired return. The stock's currently around $75. Guys, don't forget, these tools make it easier for you to make better decisions in investing. So click on the link in the description below. Go to everythingmoney.com/sign up to check it out. Hit the analyze button. Boom. Low price of 60, high price of 118, middle price of 84. And the returns down here include the dividend. So guys, if you want to see the 33 stocks that I'm hoping to buy in 2025, watch this next video. Thank you for your time.